Hey guys, today we're going to be going over 5 costly mistakes to avoid when setting up an LLC. My name is Toby Mathis, and we're going to dive into this right now. So, the first question you should be asking yourself anytime you even think about an LLC is what is it and why would I use it? So, number one, it's LLC stands for Limited Liability Company, and it's a state entity. So, whenever you think about an entity of any kind, whether it's a corporation, partnership, trust, or whatnot, I always think about it as a trilogy. There's a state element, there's a federal element, and then there's dealing with third parties like banks and judges, other contracting entities, other people. So you have state, federal, and third parties. The state is where the LLC exists. So the state, what we're doing is we're trying to give certain rights to somebody by paying the state. And those rights are basically, hey, that LLC can contract and do things on its own. And we're going to isolate the liability of that LLC from the liabilities of its owners, called members, and vice versa. And let me just draw this out. So I'm just going to share a screen here real quick, and I'm going to draw this out so you actually get a kind of a visual representation of it. And so let's just say that I was starting a business, and I'm just going to write business, and I'm going to put that in an LLC. So the LLC stands for Limited Liability Company, and I file it with a state. And that state says, if you pay me money, I am going to recognize this thing as being separate from you. So here you are out here, the member, or sometimes there's members. They're the owners of that company, and they're the ones that are operating. We'll get into all the other specifics here in a second. But from a 10,000 foot view, what we're doing is we're isolating the stuff that happens inside here in this business, so that if something happens inside that business and it fails, it does not come out here and get the owners. We create an isolation. So the courts are basically saying, we're going to charge you for protection. So we're going to make sure that if that business fails, that it doesn't come and get you as one of its owners and as the members. And therefore, people will be more likely to invest in businesses. That's what we do. Otherwise, why would you do it? If they could come take all your stuff, probably wouldn't set up a new business. It wouldn't be attractive if you were somebody with a large amount of money, especially you'd say it's not worth the risk. So what this does is it isolates that liability. It also isolates the liability of a member. So the same thing, let's say this member goes out and causes a car accident and they get sued for $1 gajillion. They can't take the assets of the business, right? There's statutory protection so that the business is protected from the members and the members are protected from that business. So that's number one. That's really important to understand, is the purpose of that LLC is to create inside and outside liability, and that's done at the state level. Then there's the federal level, and the federal level, real simple, is how is it taxed? Feds want to know how is the revenue going to come in, and we get to pick whatever we want. An LLC is basically a hybrid entity. That's why they're so popular. I could make it ignored for tax purposes, call it a disregarded entity. I could make it a partnership for tax purposes, meaning that there's, like in my example I gave, there was 2 or more owners, and we could tax that as a partnership. I could tax it as an S corp. I could tax it as a C corp. I can pick whatever taxation I want, depending on, following a couple rules. Like if you're a single individual, you can't be a partnership, but I can choose off of a menu of how I want that entity to be taxed. So that's the federal side. And then there's the third side, which is dealing with third parties like courts, banks, other groups. And this is where it really comes into our topic today, which is the 5 costliest mistakes, because one of those costly mistakes is screwing up the operating agreement. In fact, I'm just going to call that number one mistake, is people don't document the entity appropriately. And when you're dealing with third parties like a financial institution, they care about what that operating agreement says. When you're dealing with courts, they care about what that operating agreement says. When you're dealing with any third party, if you're doing a joint venture and you're using an LLC, that operating agreement is the rules of the road for you. And over again, we see people confuse what the operating agreement is with what you file with the state. Generally speaking, when you start an LLC, you're going to go to a state and you're going to file something called a certificate of formation. You're going to say, here, state, I'm going to pay you. Remember the trilogy. We got the state, and we file and we pay them money, and they think that's it. In fact, those online services are going to either just document you with the state, and they might give you a boilerplate, small little operating agreement that so you have something. But generally speaking, that's all they do. And so the costliest mistake you can make, and I've seen this over and over again, there's court cases up the kazoo on this, is screwing up that operating agreement. Don't understand, lacking in the understanding that words have meaning and that there's different provisions that you could choose to have. There's not a one size fit all in LLCs. In fact, they're very versatile. And unfortunately, there's a lot of organizations out there that don't make specific provisions that are in the benefit of the members or the managers that are setting up that entity. So, for example, I work a lot in the asset protection space. And you'll have a provision in most operating agreements that say, hey, if there's profits, you have to distribute it to the member. Okay, if you're trying to have asset protection, that kind of ruins it if somebody could just come in and get a lien against yours and entity and then just get the profits, like you're required to distribute them, and they could sue you for it. It's like, that's not a good thing. They could force it out. On the same token, if you're an investor in something, you may want to have certain rights, and they won't even look at it. They won't know what the operating agreement says. They certainly won't have the provisions in there that are for their benefit. So the number one issue I see is having an inadequate operating agreement. It does not say the things that we need. If you want to go out and get a loan, you're going to have certain provisions. If you're going to want to do financing, if you're going to do real estate versus a traditional business, if you're going to use asset protection versus not asset protection, it's all about the operating agreement. What happens if somebody passes away? What happens if there's a dispute? Who controls this thing in like at what measure? So if there's 10 members, is it a majority? Is it a super majority? Are there things that they can and cannot change? Who can sell assets? How much? Who can transact business on behalf of the company? If the company is sued, what's its position? What's its requirement? Do we do pro rata distributions? Are taxes passed down in the same percentage as your membership interest? Are there non pro rata distributions of losses versus profits? Like all of these things are covered in an operating agreement. And a lot of times people have never even thought about it. They just go onto one of the quickie sites and set something up at the state and think that's it. And they find that they'd be better off having done nothing if they're not going to do it right. Number two is this little thing called managers and members. So I mentioned that the owners are called members. You could also just choose to be managed by its members, or you could choose to be managed by a manager or managers. Again, you get to choose this. Generally, it's at the state level that you're letting them know, and then that operating agreement covers all the specifics. And so what we'll see a lot of times is somebody say, oh, I set up an LLC, and you say, how is it managed? And they'll say, I have no idea. Well, you should know, is it the members who decide, or is there a manager that's been delegated to make decisions on behalf of the company? And if so, what kind of decisions? Because let's use my same example where I have 10 owners in a company. It is possible to get it to where you'd have to have almost all of them, or it could be unanimous, vote to change out who's the manager. So if I get in there as the manager and I'm the only manager, even though there's 10 people, I could hold it up and I could remain as a manager, even if everybody else decided that they didn't want to have me as manager. It all depends on that operating agreement and what it states. Because if I said you have to have a unanimous consent to change that manager, and barring malfeasance, there's no change, it's going to be really difficult to get me out of that position. On the same token, let's say that you had 3 people in there and it said an 85% vote is required to remove a manager. That just means that you'd have to have all 3 people agree. Like 2 out of 3 doesn't win out in that case. And a lot of times we think majority rules. It depends on the operating agreement. It depends on what we think. But depending on the type of business you're running, what it holds, you may not want to have this thing be member managed because you don't want, like, say, some of your kids are members in an LLC and you don't want them to have voting rights. You don't want them to be managing the thing. You don't want to have to worry about what happens if there's a divorce and somebody else steps in there. What if somebody passes away? I want to make sure that I remain in control of this. I may want it to be manager managed. In fact, for the most part, that's what we choose because we can designate an individual or individuals or even another company to act as the manager for an LLC and make it really, really, really difficult to change that out. And what that does is it gives us a higher degree of control and make sure that we're very specific about who's going to be operating our business. Number 3 of the 5 costliest mistakes when setting up an LLC is something called undercapitalization. Now, I tend to incorporate businesses in states that have favorable statutes, if at all possible, but it's not always possible. If I'm going into a state that is, like, let's say, I have real estate in a jurisdiction, I may be forced to have a local entity. What's really important is that you understand that you have to meet the statutory requirements, including the requirements under common law, meaning that the courts. And one of those provisions is this thing called undercapitalization. You cannot go out and create liabilities for yourself that are in excess of what that company generally has the ability to repay. In other words, if you contract with somebody and default and your entity had no money in it and no assets, there's a good chance the court's going to look at that and say, it's against our public policy to allow people to escape liability simply by paying the state a little bit of money, knowing full well that they cannot satisfy that liability and they don't have the means to do it because they never put enough money in the company in the first place. It's called an equitable argument, and it's a piercing argument where somebody will go to the court who's aggrieved and say, I'm not getting paid. You should not recognize this LLC because it's unfair. It's inequitable to me because they did not have enough money in that thing and they knew it. They knew they didn't have enough money and they were writing checks that they couldn't cash. Court, please ignore that LLC. Please do a piercing so I can go after the members. After all, these guys controlled it, or these were the ones that inflicted this inequitable occurrence on me, and the results would be unfair and against public policy in this jurisdiction if you were to enforce that LLC. That's what a piercing is, and that's what they're going to do. It's an equitable argument where you say it's unfair, even though they set up the LLC correctly, they did not put enough money in it, and that's going to cause a problem. Number 4, and this is the one that I see quite often with people that are kind of running fast and not crossing their T's and dotting their I's, and that is just poor record keeping. It does not matter if the state says all you have to do is file once a year, or some states you don't even have to do that. You may just have to pay the franchise tax or whatnot. Every state's a little bit different, but for the most part, it's you pay the annual renewal and you're good. You don't have to have meetings. You don't have to do any of that stuff. Okay, that might be true with the state. That is not true with the feds. In fact, there's no distinguishing between an LLC and a corporation and a partnership and a sole proprietor when it comes to books and records. You have to maintain adequate books and records in any business. And if you want to see a costly mistake, set something up and don't keep good books on it, because if you're audited, you're going to lose because you have to show adequate record keeping of your income and your expenses. And if you do not do those, the courts and the feds and anybody is just going to say, you didn't show respect to your entity, I'm not going to show respect to your entity. That's the best rule of thumb I could ever say is expect third parties to treat your entity with the same amount of respect that you show your entity. Failure to do so could lead to costly consequences. And one of those is, especially if you're ever audited, if you are not keeping good books, records of your income and your expenses, if you don't have a balance sheet, If you don't know what those words mean and you've never heard of QuickBooks, chances are you need to talk to somebody to make sure that you are creating a paper trail for that entity. Because after all, we are getting a bunch of benefits for setting this thing up. I'm going to reduce my liability. Quite often, I'm getting tax benefits. I have estate planning benefits. I have a whole bunch of benefits. What's the cost? The cost is you have to do things according to the rules. You got to follow those rules. And one of the big ones is from the feds. And they say, I don't care what kind of business you are, you got to keep track of those income. You got to keep track of those expenses. You got to keep track of those assets, and you got to keep track of those liabilities. Failure to do so could lead to us imploding the thing or denying you deductions or treating it all as you, and that can have dire financial consequences to you. So please, when you set up an LLC, understand that it is a separate being. It is a separate entity. It is not you, and we need to have a paper trail on it. Your bank account is not sufficient. It needs to have its own set of financial records. It needs to have its own account under most circumstances so that the courts will look at it and the feds will look at it and say, aha, I understand what's the story behind this, and I can see its numbers and I can track it. You do that, you're going to be good. You don't do that, it's going to be bad. And number 5, for costly mistakes people make when they're setting up an LLC or operating an LLC, is a lack of understanding of what's required for licensing, things like franchise taxes, things with the state that they don't even realize that they have to do. It's like they set up an LLC to set up their business. They go lease a place and they think they can open up and run a restaurant right out of it. They can run whatever, fill in the blank, a mini mart, or they can run whatever they want. And they don't realize that just because it's an LLC doesn't mean that it doesn't still have to get a business license. There might be some franchise taxes depending on the type of entity. For example, in California, you set up an LLC, you're paying $800 a year for franchise taxes, 9 times out of 10, probably 99 times out of 100. And you got to make sure that you're paying that. Failure to do so could lead them to penalize you and add all sorts of interest and fees. And it just depends on the state. I'm in Tennessee, and I don't realize that there's a family-owned non-corporate entity thing that I can file, and I don't file it, and I end up getting hit with a bunch of franchise taxes. Or there's everywhere, there's always little nuances. Hey, I set up in Nevada. I don't realize that I have business license. It used to be a big issue. Now they just make it part of the filing process. But there can be penalties and interest for failing to file these things if they are due and when they are due. And a big mistake people make is they have no idea, so they just do nothing. They stick their head in the sand, and they don't realize that they're accruing some nasty penalties and some financial obligations that they're going to have to pay. Because after all, again, we're getting a big benefit out of this LLC, and there might be a price to pay that's beyond just paying the state a filing fee with the Secretary of State. There might be a taxing authority. There might be local jurisdictions. If I open up a restaurant, for example, I probably have to get a specific license, business license for that restaurant, and failure to do so could keep my doors shut, subject me to penalties, possibly even crime, right? So I need to make sure that I'm aware of my licensing requirements and I'm aware of my tax obligations in the jurisdiction in which I am operating, which kind of begs the question. Some jurisdictions are better than others, and maybe we can avoid a bunch of tax depending on the type of business it is, depending on where we set it up. And that leads me to my last rule of advice is, if you do not know, talk to somebody who does, so that you can make sure that you don't make a mistake that ends up costing you money or loses you the benefits for which you paid. And that is why we want to make sure that we do not make those types of mistakes. You just ask somebody, and a little bit of diligence yields great results. And somebody who does this day in and day out usually will be able to parse this down and look in that jurisdiction and say, here's what you have to do. Here's this, that, and the other. Or they've already been there and done it a million times. Like our firm, we've done thousands and thousands all over the country. So we know the ways of the road. Don't skimp on these things, guys. There's a ton of benefits that are with a properly structured entity, and you can undo it like that by failing to follow just a few simple rules. So I just gave you 5 costly mistakes that you can make when setting up an LLC. Hopefully you'll never make those mistakes now, and you'll get all the benefits of that LLC that you've worked so hard to come up with money and with ideas, and you're putting your sweat and blood and tears into this thing, and you get all the benefits so that you can be successful and you can create a really cool legacy. And after listening to this, you'll never be one of those people that makes one of those 5 costly mistakes. Hey, if you like this, please click like, share it with people that you think could benefit for it. And if you can, in the comments, let me know what you think, or let me know of other ideas that I can cover in the future, as this channel is very important to me and I love sharing information. And if you give me a good idea, I promise you I'll give it a fair once over. And if it's really good, I'll make it into a video.